Hello everyone, and welcome to our first lesson on recording financial transactions in the FA1 chapter. As promised, we will start from the very beginning and we'll keep everything very easy to understand. Today, we're going to focus on two key areas: the definition of accounting and the definition of financial accounting. First, we'll provide you with 5 very good definitions of accounting. After that, we'll take a closer look at 3 of these definitions to help you understand them better. Then, we'll move on to 5 of the most credible definitions of financial accounting. Again, we'll explain and interpret 3 of these definitions in detail. Don't worry at all. Our goal is to make your journey as smooth and easy as possible. We'll break everything down step by step, and you'll have a solid grasp of these concepts in no time. Remember, every expert started as a beginner, just like you, and with practice and patience, you'll succeed. Stay motivated, keep a positive mindset, and remember that each lesson is a step forward in your learning journey. We're here to support you every step of the way, so let's get started and make this an exciting and successful learning experience together. Here are 5 highly regarded definitions of accounting from authoritative sources. 1. American Institute of Certified Public Accountants, AICPA. Definition: accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events, which are, in part at least, of a financial character, and interpreting the results thereof. Source: AICPA Committee on Terminology. 2. International Financial Reporting Standards, IFRS. Definition: accounting is a system of recording, summarizing, and analyzing financial transactions to provide useful information to stakeholders. Source: IFRS Foundation, Conceptual Framework for Financial Reporting. 3. Financial Accounting Standards Board. Definition: accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Source: FASB, Statement of Financial Accounting Concepts Number 1. 4. Oxford English Dictionary. Definition: the process or work of keeping financial accounts. Source: Oxford University Press. 5. Investopedia. Definition: accounting is the systematic and comprehensive recording of financial transactions pertaining to a business. It also refers to the process of summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. Source: Investopedia, Definition of Accounting. These definitions encompass the essential functions and purpose of accounting, offering a broad understanding suitable for various contexts. Let's break down and interpret the definition of accounting provided by the American Institute of Certified Public Accountants, AICPA, for a beginner. AICPA definition: accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character, and interpreting the results thereof. Interpretation. 1. Art. Accounting is referred to as an art because it involves applying principles, judgments, and creativity in recording and reporting financial information. 2. Recording. This means keeping a detailed and accurate record of all financial transactions. Think of it as writing down everything that happens financially in a business. 3. Classifying. After recording the transactions, they are sorted into categories. For example, all sales transactions are grouped together. All expense transactions are grouped together, and so on. 4. Summarizing. This involves compiling all the recorded and classified transactions into reports that are easy to understand. This usually means preparing financial statements like the income statement and balance sheet. 5. Significant manner and in terms of money. This emphasizes that only transactions that can be measured in monetary terms and are significant to the business are recorded. 6. Transactions and events of a financial character. This specifies that accounting deals with events that have a financial impact on the business, like sales, purchases, salaries, etc. 7. Interpreting the results. Finally, accounting involves analyzing the financial data to understand what it means for the business. This could involve determining how profitable the business is, how well it is managing its expenses, or how much cash it has available. Let's interpret and explain the definition of accounting provided by the International Financial Reporting Standards, IFRS, for a beginner, along with a comprehensive example. IFRS definition. Accounting is a system of recording, summarizing, and analyzing financial transactions to provide useful information to stakeholders. Interpretation. 1. System. This indicates that accounting follows a structured and organized process with specific rules and procedures. 2. Recording. This is the process of documenting every financial transaction that occurs in a business. It involves noting down all monetary exchanges. 3. Summarizing. After recording the transactions, the next step is to condense this information into a more understandable and manageable form. This usually involves creating financial statements such as the income statement, balance sheet, and cash flow statement. 4. Analyzing. This involves examining the summarized financial data to gain insights into the business's performance and financial position. It helps in understanding trends, identifying problems, and making decisions. 5. Financial transactions. These are exchanges of money or value that affect the business's financial situation, such as sales, purchases, payments, and receipts. 6. Useful information. The end goal of accounting is to provide information that is helpful and relevant for decision-making. 7. Stakeholders. These are the individuals or groups who are interested in the financial information of the business, such as owners, investors, creditors, management, and regulatory agencies. Let's break down and interpret the definition of accounting provided by the Financial Accounting Standards Board, FASB, in a simple way for a beginner. FASB definition. Accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Interpretation. 1. Identifying. This means finding and recognizing the financial transactions that need to be recorded. For example, every time you sell a product, buy supplies, or pay an employee, these are transactions that should be identified. 2. Measuring. After identifying a transaction, you determine its value in monetary terms. For instance, if you sell a product for $50, you measure the transaction as $50. 3. Communicating. This involves sharing the recorded information with others. Typically, this is done through financial statements like income statements, balance sheets, and cash flow statements. 4. Economic information. This refers to any data related to money and finance within a business, like sales, expenses, assets, and liabilities. 5. Informed judgments and decisions. The goal of accounting is to provide clear and accurate financial information so that business owners, managers, and other stakeholders can make smart decisions about the business. Here are 5 of the best and most credible definitions of financial accounting, along with their sources. 1. Financial Accounting Standards Board, FASB, definition. Financial accounting is the process of preparing financial statements that companies use to show their financial performance and position to people outside the company, including investors, creditors, and tax authorities. Source, FASB. 2. International Financial Reporting Standards. Definition. Financial accounting involves the preparation of financial reports for external use, ensuring transparency, accountability, and efficiency in financial markets. 3. American Institute of Certified Public Accountants, AICPA. Financial accounting is focused on the preparation of financial statements that provide information about a company's performance, financial position, and cash flows to external users for decision-making purposes. Source, AICPA. 4. Chartered Institute of Management Accountants. Definition. Financial accounting is the field of accounting concerned with the summary, analysis, and reporting of financial transactions related to a business. CIMA. 5. Investopedia. Definition. Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. Source, Investopedia. These definitions give a clear picture of what financial accounting is and emphasize its role in providing important financial information to people outside the company. Here's the definition of financial accounting from the Financial Accounting Standards Board, FASB, explained simply. Definition: financial accounting is the process of preparing financial statements that companies use to show their financial performance and position to people outside the company, including investors, creditors, and tax authorities. Explanation. 1. Preparing financial statements. Financial accounting is about creating reports that show how a company is doing financially. These reports include things like how much money the company made, income, how much it spent, expenses, and what it owns and owes, assets and liabilities. 2. Financial performance and position. The goal is to provide a clear picture of the company's financial health. Performance refers to how well the company is doing in terms of making a profit or loss. Position refers to the company's overall financial situation at a specific time. Number 3, people outside the company. These reports are meant for people who are not directly involved in running the company, but have a stake in it, like investors who want to know if they should put money in the company, or creditors who want to ensure the company can repay its loans. Example, scenario. Imagine you have a small bakery. 1. Preparing financial statements. At the end of the month, you create a few key reports. Income statement. Shows how much money you made from selling baked goods and how much you spent on ingredients, wages, and other expenses. Balance sheet. Shows what your bakery owns, like ovens and cash, and what it owes, like bills for supplies. 2. Financial performance. You see from your income statement that you made $1,000 in sales and spent $700 on expenses, leaving you with a profit of $300 for the month. Number 3. Financial position. Your balance sheet shows you have $500 in cash and $200 in unpaid bills, giving you an idea of your bakery's financial health. These financial statements help anyone interested in your bakery, like potential investors or banks, understand how well your bakery is doing and whether it's a good investment or if you're able to repay a loan. Here's the definition of financial accounting from the International Financial Reporting Standards, IFRS, explained in a simple way. Definition: financial accounting involves the preparation of financial reports for external use, ensuring transparency, accountability, and efficiency in financial markets. Explanation. 1. Preparation of financial reports. Financial accounting is all about making reports that show how a company is performing. These reports include details like revenue, expenses, and overall financial health. 2. External use. These reports are meant for people outside the company, such as investors, creditors, and regulators. They help these people understand the company's financial status without being directly involved in its day-to-day operations. 3. Transparency, accountability, and efficiency. Financial accounting ensures that the financial information is clear. Transparency, that the company is responsible for its financial actions, accountability, and that the financial processes are effective and streamlined, efficiency. Example, scenario. Imagine you run a small online bookstore. 1. Preparation of financial reports. At the end of the year, you create income statement, shows your total sales, costs of books and shipping, and the profit you made. Balance sheet lists your assets, like books and cash, and liabilities, like unpaid bills. 2. External use. If you're looking to get a loan from a bank, the bank will review these financial reports to decide if they should lend you money. 3. Transparency, accountability, and efficiency. By preparing these reports accurately and clearly, you make sure that the information about your bookstore's finances is open and understandable. You show that you are managing your finances responsibly. You keep your financial processes smooth and straightforward. These reports help others see how your bookstore is doing financially and ensure that your financial practices are honest and effective. Here's the definition of financial accounting from the American Institute of Certified Public Accountants, AICPA, explained simply. Definition. Financial accounting is focused on the preparation of financial statements that provide information about a company's performance, financial position, and cash flows to external users for decision-making purposes. Explanation. 1. Preparation of financial statements. Financial accounting involves making key reports that show how a company is doing. These include statements that detail income, expenses, and overall financial health. 2. Company's performance, financial position, and cash flows. Performance. How much profit or loss the company has made over a period. Financial position. What the company owns, assets, and owes, liabilities, at a specific point in time. Cash flows. How money is coming in and going out of the company. 3. External users. These financial statements are meant for people who are not directly involved in the company, but need to make decisions based on the company's financial information, like investors, lenders, or analysts. 4. Decision-making purposes. The goal is to provide clear and useful information so these external users can make informed decisions, such as whether to invest in the company or provide it with a loan. Example. Scenario. Imagine you own a small restaurant. 1. Preparation of financial statements. At the end of the month, you prepare. Income statement. Shows your total revenue from food sales, expenses for ingredients and staff wages, and your net profit or loss. Balance sheet. Shows what your restaurant owns, like kitchen equipment and cash, and what it owes, like unpaid bills. Cash flow statement. Details how cash is coming in from sales and going out for expenses. 2. Company's performance. Your income statement reveals you made $5,000 in sales and spent $4,000, leaving you with a $1,000 profit. 3. Financial position. Your balance sheet shows you have $2,000 in cash and owe $500 in bills. 4. Cash flows. Your cash flow statement helps you see that your restaurant's cash balance increased by $500 this month. These financial statements help external users, like potential investors or lenders, understand how well your restaurant is performing, what its financial position is, and how its cash flows are managed, guiding their decisions about getting involved with your business. That wraps up today's lesson on ACCA FA1 recording financial transactions. I hope you found it helpful and enjoyable. Remember, every bit of effort you put in now will pay off in your exams. Stay motivated, keep practicing, and I'll see you in the next lesson. Together, we'll make sure you're fully prepared to succeed. Keep up the great work, and don't forget to like and subscribe for more. See you soon.